I think we'll get going. Good morning, everybody. Hopefully this is all going to work okay. I'm obviously not in my normal place. We'll be running through the news this week as normal. There's not much going on, as you might imagine, since we approach the summer holidays. But this week's guest, I think, will be interesting. So that's Phil Kent, who's the Vice President Advisor to GCP Infrastructure. So without further ado, let's have a look at some news. He says, there we go. As I said, there's not much going on, so I just picked out a couple of results that I thought might be worth exploring a bit. So one of those is Polar Capital Technology, and the other one is Henderson Diversified Income. Polar Capital Technology, the results that were published this week, they run until 30th of April, actually. That's true of both of these funds. It benchmarks itself against the Dow Jones World Technology Index, and over that period, the index fell by 10.1% in dollar terms, but only 0.9% in sterling terms because of the weakness of the pound. The NAV in sterling, that is down 7.7%. As we'll see in a second, that's actually one of the worst relative performances that the fund's been in for a while. And the share price was worse than that again because the discount widened. Since the end of the period, we've seen a small uptick actually in the technology market, and definitely in sterling terms again this is, and actually a small narrowing discount too. So things are perhaps perking up, but I don't know how sustainable that's going to be. It is on a chart form, and you can see there the sort of incredible rise that the technology has had over the past sort of 10 years. And then the pullback, which actually just really takes us back to levels of kind of mid-2020. And the fund's discount now is actually sort of the wider end of its range. So this is the sort of time when normally you'd be thinking about don't want to buy some. Here we are in terms of the calendar year performances, and this is what I wanted to point out. So in terms of the relative performance, it's actually not great. So it's given back a lot of the excess returns that it made in the sort of 2017, 18, 19 period. There's good reasons for that, though, as we'll explain. And this is just looking at the NASDAQ and where we are now. So as I said, it's off the bottom, but not very far off the bottom. As I said, it's just taking us back to where we were in 2021. Hang on, how come backwards? There we go, this way. So I suppose the story really is all about stock selection. I mean, there's always an asset allocation impact to this, but it's only kind of minor. Generally, because the fund has always had a bias towards growth stocks, and what Ben is normally trying to do is capture things as they become more rapidly adopted by the general populace. So things like electric vehicles that were a rarity a few years ago are now becoming more commonplace. And as you get that period, you see sort of much faster rates of growth, so almost exponential rates of growth. But those aren't the sorts of things that the market's favouring at the moment. They're looking more for the kind of steadier, slower growing perhaps, but more cash generative type stocks. And those include things like Apple and Microsoft, which the fund has an underweight exposure to. It's also overweight small caps relative to its benchmark, and that has been helpful. And then where I think perhaps you could criticise Ben a little bit, he did hold on to some stocks that did perform extremely well because of COVID. So either they were things like DocuSign, where the need to sign contracts remotely meant that they had a big boost in their business through COVID. You might have thought, well, perhaps that's going to fizzle out. But also things that just couldn't sustain the rate of growth that they had, things like Netflix and Amazon, PayPal. So those things actually pulled back returns a bit. It's a very US-centric portfolio, but that just reflects where the technology market is really. And this is why the weak pound made such a big difference to returns, because actually it doesn't have, you can see there, it doesn't have any UK stocks in the portfolio at all. Now, I kind of think that given the sorts of economic policies that our Prime Minister candidates are coming out with. The pound might be weak for some time yet. So actually, these sorts of things might be relatively good place to be. In terms of market cap, it is actually quite a large cap weighted fund, but actually relative to the index, it is slightly underweight. And I said small cap underperformed. There's some numbers there that just illustrate that. There's quite a big gulf between the small cap Russell 2000 and the larger cap Russell 1000 index. And then this is the top 10 holdings. This is all these numbers. Actually, I'm showing the charts. These are all at the end of June, so just showing you up-to-date stuff. But not much has changed really since the end of April. So even though the fund has got 11.5% in Microsoft and 9% in Apple, that's still underweight relative to that benchmark. So there isn't much that Ben could do about that without skewing the fund, I think, far too much to those two big stocks. I always lean towards caution in terms of doing that, I think. And then I suppose this is the real key question here is the sort of reaction to growth stocks sensible? And the point that Ben's trying to make here actually is that in terms of the underlying earnings and revenue, these companies are actually still doing very well. They are growing, and they are growing relatively quickly. Actually, relative to the market, they may be not looking as spectacular as they normally do because we've had this huge uplift in earnings for things like oil companies and mining companies. But the technology stuff should be more sustained, I think. And that's really why you'd argue that they should trade on higher multiples. So it really does come down to kind of sentiment change and valuation compression rather than a change in the underlying fundamentals of these businesses. So this is what Ben says about valuations. This is in his outlook statement, which is obviously written probably only like a week or two ago. So really, he's saying things relative to recent history, at least, look much more attractive. But I suppose what we were in a sort of slightly different period than we have been in any time over the past kind of decade. And so inflation recession might have a real impact on this, and we might still see more derating of equities. So I'm not saying this is a screaming buy, but I just think it is interesting that valuations are looking better, while the revenue forecasts aren't looking too bad. He does caution that margins are quite elevated for these stocks. And I suppose that does suggest that we may see some competition eroding those margins. So I'd say he's probably cautious, but not. This is not sort of looking at disaster in the face. And I suppose this is the key thing, that he thinks that stocks have started to price in recession risk. So he's now out there looking for some bargains. The fund's got cash on hand to deploy in the market. And so I hope that this is the time when he's going to start building the portfolio that's going to deliver the outperformance and recapture the underperformance that we saw last year. The main thing that will do that, though, is obviously if Microsoft and Apple underperform, which I guess will happen if we get this shift back into growth, which may not happen this year, but probably will have happened by the time we get to the end of next year. That's that one. Henderson Diversified. Actually, Patrick asked a question there. I should address that. Why are the benchmarks on a 10-year chart? That is something we've asked Morningstar for many, many, many years, and it's not been able to do that, I'm afraid. Benchmark indices, actually, access to them is very expensive, and it's not the sort of thing that we can meaningfully afford without sort of maybe charging you to see it, and it's not something you want to do. There we go. So Henderson Diversified Income. This was really looking quite solid until the beginning of the year, and you can see how far and how fast it's fallen away since. and the discount opened up and has not closed again. And there obviously are good reasons for that. First of those is that its performance relative to the rest of the sector has been pretty dire. It's the worst performing fund in its debt, loans and bond sector over 1 year, and that's dragged down the longer term numbers too. So nothing looks too clever here, but you know, it's looking particularly poor. Relative to its benchmark, which is now a composite of various different types of bond indices, that dropped 7%, the NAV dropped 9%, and again the discount widened, so it's down 10.4%. The good news, I suppose, is that it's still being able to maintain the dividend. So 4.4p, which puts on a yield of getting on for 6%, and that's covered by revenue. And that's been something that the manager's been keen to make sure was the case for a long time. So a lot of the actions that they took a couple of years ago were all about making sure that the dividend was going to be protected, and that's played out in practice. Now, in terms of what's gone wrong with this fund, the problem obviously has been inflation. They had a fairly consistent message that we were relaying to you in the notes that we were writing on it, that inflation was transitory, and so that even though there was an uptick, it was going to be fairly temporary, and the underlying things like demographics and aging populations and things would and technology and would drag back inflation back down again, and we end up with sort of low growth, low inflation scenario again. They call it sort of Japanification or something like that of the economy. Where they say they came unstuck is that they didn't anticipate that the supply chain issues that were related to the emergence from the COVID lockdowns would persist. But the big one, I suppose, is Ukraine. So because we've had the huge spike in energy prices, that's been a major reason why inflation has been much higher than expected, and it's now becoming much more entrenched, I think. Another thing that they did that made complete sense to me was to focus on high quality issues. So companies that they thought wouldn't have any trouble in terms of servicing their debt. So not cyclical businesses, and not things that were challenged by new competition. So old economy businesses, if you like. That you'd think that would have worked. You'd think there'd be some kind of flight to quality going on in this environment, but actually, as we've seen in the equity market too, that hasn't happened. And so, even though recession seems to be looming, there is no premium being paid for quality at the moment. They think that's going to pan out in the end, but we'll see. And they also focused on longer dated debt, because part of this idea of where we're going to sort the dividend out for the foreseeable future was to buy the debt issued by these high quality issues and buy it, lock it in for the long term. Inflation we don't have to worry about, so we don't have to worry about longer dated stuff. Obviously, at the moment, having long dated stuff has been particularly bad news, and so that's worked against them. So this is some of the stuff that they've been saying. So they are thinking that although the picture doesn't look too great now, actually this is a temporary problem still. One area that they didn't have that maybe they could have had more of was loans, because these tend to be floating rate rather than the fixed rate debt that they normally buy. And obviously, as interest rates go up, then the loan returns go up too, and that would have been quite helpful. But actually, the opening yields on loans weren't great. They definitely weren't high enough to make the dividend sustainable. And so that was the argument for not doing that. And we talked about quality already. And again, they were worried about the quality of some of the loans that have been made, because they think that people only turn to the loan market when they couldn't tap the bond market. And so therefore the quality of loans is actually worse than the quality of bonds. And again, they're just repeating that statement I made earlier on, that they think the quality will out, if you like. So the other thing that the fund looks like it's doing, it looks like it's got enormous quantities of gearing, and that's kind of magnifying some of the moves. Again, that's designed to help maintain the income flows. So by borrowing it relatively cheaply and then investing in stuff on a high yield, they're capturing some income. That obviously makes things slightly more volatile than they would be otherwise. But yeah, I think they're saying that they've got doing it to the minimum now that they need to do to cover the dividend and no more. So we'll see what they say. I think the situation is we were probably going to look about writing another note on this in the next couple of months, and so we'll talk to the managers and then address some of these things then. There's a question about stagflation. I haven't seen anything they've written on that, but I can go away and have a look and maybe come back and tell you another time. And then the other thing is like saying, having bought high quality issues, does that mean lower yields? There's a difference there. It's slightly nuanced, but basically, yes, if you've got something with a credit rating of A compared to a credit rating of BBB, then that tends to have a much lower yield. But what they were trying to do was kind of second guess those ratings and say that even though credit analysts were saying this is a BBB, we think it's much more defensive than this BBB because the underlying business is that much better. So it is such a nuanced thing. Okay, let's move on, I think. So that's enough from me. We're now going to talk to Phil.